So if you've been watching my channel here on YouTube, you know that I invest for dividends and cash flow. And you've probably heard me say more than once that I don't really care about capital appreciation or capital gains, meaning when a stock price goes from a lower price to a higher price, because I only invest for dividends and cash flow. Meaning I don't really care where the stock is going because I just don't plan on selling. And I do care about the dividends, and especially the growth of the dividends, because I plan to live off of the dividends. I plan to use them to pay for my living expenses. And so I've said more than once, I don't really care where the stock goes. I don't care about the capital appreciation. And that is completely true. But I have a secret that I want to share with everyone today. I secretly do care about capital appreciation, and I think it's possible for one to not care and to care simultaneously for the same stock in the same universe, and it is possible for both of those statements to be totally true. And so in today's video, I want to share why I secretly care about capital appreciation, even for a dividend growth investor who never plans on selling. Hey everyone, Ian here, ppcian.com. Thank you so much for being here. Today's video is actually in response to a subscriber question. I got a great question. I believe I actually already answered it in the comments itself, but I wanted to take the opportunity to make this an entire video because I think it's really important. And so the question was asking me, hey Ian, I know you invest for dividends. I know you invest for dividends and cash flow. You've mentioned multiple times you don't care about the stock price, capital appreciation, because you're just looking at your stream of dividends because that's what you can use to pay the bills. And because you're never planning on selling, it doesn't really matter to you whether the stock is going up or not. But Ian, you know what? At the end of the day, don't you care about your total returns? Don't you care about your portfolio value? Don't you care about all of those things? And the answer is yes. But the answer is yes, really from a standpoint that's probably a little bit different than what all of you are thinking. And so I wanted to share today why I think it is important to look at capital appreciation, capital gains for dividend investors, and how it's possible to care and to not care at the same time. And in fact, how this dual strategy of caring and not caring has really helped me be a better dividend investor and a more successful dividend investor. And so I want to start with bucket number one. In bucket number one, the stock price, it might even be going down. I don't care. I don't care because I am not buying for stock price. I am buying purely for the stream of dividend incomes. I'm not buying to buy low and sell high. I'm not planning on ever selling. I am simply buying for my stream of dividends. And so even if the stock is going down, I'm losing money, quote unquote, losing money. I'm not observing capital appreciation. For this dividend investor, this typically doesn't matter. Of course, as long as the fundamentals of the company are strong, as long as I'm selecting the right companies, world-class companies that are doing well. If Mr. Market thinks that the stock is worth less today than it was yesterday, so be it. Obviously, it's a different case if the company is completely deteriorating and I made a mistake potentially and bought the wrong thing and it's going down for fundamental reasons, then it surely matters. But again, this hypothetical scenario here, I'm assuming the best of the stock. I'm assuming it's one of my favorites. It's a world-class stock and it's just going down. The reason it doesn't matter, and first, the timing of when it doesn't matter. It doesn't matter the moment I buy. And the reason it doesn't matter the moment I buy is when I buy, I am buying for the dividend. And so if tomorrow my stock is worth less than it was the day before, it doesn't really matter because as long as the fundamentals are solid, as long as my dividends keep coming in, I am getting everything that I was promised, that I was hoping for when I bought the stock. And so I wasn't buying for it to go up. I was buying for the dividends, and as long as I'm getting those dividends, it's all good. It also doesn't matter the moment I buy because I need it not to matter. I need it not to matter really for my ego and for the ego side of things. And so let me talk about this a bit. When you invest for dividends, as long as I have been over the last 20 plus years, you observe a lot of ups and downs. And sometimes the down cycles are not that easy. Sometimes they're aggressive. Sometimes portfolio values can shrink. And so this is actually one of the reasons that I have become a dividend investor, because dividends, despite the economic cycle from world-class companies, they keep going up. And so I can focus on the dividends. I can invest for the dividends. Regardless of where the stock price is, I can see progress. And that's the key thing. I can see progress towards my goal where my dividends cover all my living expenses. But for my ego, if I were to check the stock price every day, if I were to see the stock price going down, and that was something I was really interested in avoiding, if it was something that was really detrimental to my strategy, it just wouldn't work out. I just don't even see how it would be possible to be an investor that way. And so it just doesn't matter for me once I start buying stock, once I own the stock. From an ego standpoint, I just can't look at it that way. I can't get caught up in my net worth, in the portfolio value, on the ego side of things, because it just wouldn't be conducive to what I'm trying to achieve long term. And most importantly, once I buy, the stock price going down, it just doesn't matter from a dividend standpoint. Like I said, as long as the fundamentals are strong, as long as the company is doing well, regardless of where the stock price is, the dividend will keep going up. And so that's what's great, is the moment I buy, putting my ego aside, just focusing on the dividends, all that matters for me is the dividends. And so I love this bucket. This is how I have traditionally thought about things. It has helped me survive so many down cycles in the market. And in fact, it has helped me flip it. When there's a down cycle, and historically maybe my ego would have gotten hurt, I like to look at it as a buying opportunity. I like to look at it that the stocks are on sale. It's a bargain basement price. It's on sale. It's a good time to buy. And so I like to flip it. Maybe it's good for the ego in the sense that I'm getting a value. I'm a value shopper. I'm getting value for my money. But just being in it as long as I have, I don't know how it would be possible to look at it any different way than this. And this is the magic of dividend growth investing, because one can completely isolate themselves from the noise. They can isolate themselves from the TV programs, the talking heads, the bells, the buzzers, all of that noise that comes with the stock market, the trading, all of that stuff. Go on the sidelines and focus on dividends. And it is so foreign. It is so foreign to I shouldn't say everyone, but a lot of the institutions, a lot of the investors out there, that a lot of people don't even understand this strategy. But this is exactly the essence of why I like it, because the capital gains don't matter. But let's look at this now a different way. Simultaneously, in the same universe, capital gains do matter to me. And why do they matter, and when do they matter? One, they matter before I buy. I recently did a video on GE, and I'm going to link to it in the description below. GE is a stock that I don't own, I have never owned, and I will not be buying. And if you do own GE, though, by the way, I wish you well. I wish you very well, and I hope it does well. It's just not for me. But one of the things that went into my fundamental analysis of GE is just, where has the stock price gone? Where has it gone over the last 20 years? It's literally gained no traction since 1996. And so the fact of the matter is, if you bought in 1996 and now here we are in 2018, the stock price is basically flat. And the fact of the matter is that doesn't include dividends, by the way, but the stock price, just capital appreciation, hasn't been existent. I don't care if a stock goes anywhere in maybe a 5-year period, but when one is looking at 10 years or more, I like to see capital appreciation because it's indicative of a well-managed company. If a stock price is not increasing, is the management team really doing their job? Are they really creating value? Is the company really growing? Is it doing well? Is it going to be able to support higher dividends in the future? Probably not. And so for me, capital appreciation, I look at it and it matters before I buy. Before I buy, I like to look and see, has this stock over the long term gone somewhere? I don't care if it's not been anywhere in the last 5 years. In fact, when I buy, I often buy when a stock is down. So maybe over the last 10 years, it's up. Last 5 years, it's corrected. It's done that for a reason. I'm okay with the reason. That's often when I buy. But if it's gone nowhere in 10 years or 20 years, that's oftentimes a indication to me. It's oftentimes a point on my analysis list. Hey, Ian, what's wrong with this management team? What's wrong with this company that's gone nowhere in such a long time? And so that's why simultaneously capital appreciation does matter to me. It matters to me in my analysis, when I am doing analysis. Not when I'm actively managing my portfolio. Not once I've bought, really. Although the third point is ongoing check-ins. When I do periodic check-ins on my holdings that I already own, I like to see over the long term, I'm talking 10 plus year time frames, that it has appreciated, that it has done well. And so This is how these two can simultaneously exist for a dividend investor. On the one hand, capital appreciation at the core of my strategy doesn't matter because I'm investing for dividends. It allows me to sideline myself in the market, stay away from the noise. It allows me to focus on what matters for me. It allows me to stay strong. It allows me to put my ego aside. It allows me to stay strong and focused on what matters and to generate cash flow that can be used to pay bills. Because you can't pay bills with buy low, sell high unless you literally sell. But with a dividend, you can pay the bills as the checks come in. And so that's where I like to stay focused. I block out the noise. But then again, when I step back from time to time, maybe I'm analyzing a new stock. Maybe I'm analyzing an existing stock in my portfolio. I'm looking at long time periods. I will look at capital appreciation and I will value it quite a bit from the standpoint that it matters. And it matters because it's an indication of a solid company. And this is what's weird. It's like, mathematically speaking, is it possible for these two to coexist? I don't know. I'm not a mathematical theorist, but what I would say from a philosophical level, and this is what's interesting about life, is sometimes it is possible for two opposites to be true as long as they're bucketized in their own use cases. And so for me, both buckets are true, and that's my big secret here on PPCE, in that I do value capital appreciation. It's just different than how a lot of people value it. I use it for my analysis. So I want to share one more thing. What's great kind of looking at both dividends and capital appreciation is dividend investors get the best of both worlds. They enjoy the dividends and they enjoy the capital appreciation. Whereas with a buy low, sell high investor, they only enjoy the capital appreciation. They don't really care about the dividends. And what's great about a dividend investor is dividend investors can be like me. They can live in both universes. They can be here and here. It can matter and it cannot matter. And most of the time, the capital appreciation doesn't matter for me, and it allows me to be strong. It allows me just to ignore the noise and be the best possible investor I can be, which I honestly think is one of the biggest challenges an investor is staying in the game, staying focused, blocking out the noise, and staying on one's path even when times get hard, because they will get hard. They will get very hard at certain points in one's investing career when they've been in it long enough. And that's what I love about being a dividend investor. But being a capital appreciation investor, one doesn't get this bucket. One doesn't get this luxury. One forgoes this luxury. They're just in this bucket. And so they have to be tied to the stock price. And that can be so scary. It can be so risky because we just don't know what Mr. Market is going to think of a particular stock tomorrow. It might like the stock. It might not like the stock. Benjamin Graham, one of Warren Buffett's mentors, and Warren Buffett, they talk about the market as this voting machine. One day market's happy, one day it's sad. It's really hard to be tied to those emotions of the market when one has no control over them, and that's one's only source of upside. That's scary, and that's why I'm not an investor for capital appreciation. I'm not a buy low, sell high investor. I'm a dividend investor because I get the best of living in both worlds. And why would I want to forego this world, which is where I think a lot, if not most, of the value comes from. So just a fun video today, response to a subscriber question. Thank you for that question, by the way. That was a really good one. And please keep the questions coming. If you enjoy the content here on my channel, PPC Ian, I please invite you to like, to subscribe, to comment. I try to answer all of the questions that come through here. Also, I'm on Instagram. I'll link to it below if you want to engage with me there. I'm actively checking in. I'm answering questions on Instagram. It's also a friendly disclaimer. Today's video is not investment advice. I am not a licensed investment advisor. Today's video is just for your fun and entertainment. If you are going to go out and invest money in the stock market or anywhere else, please do consult a licensed financial advisor first. Thank you so much for being here, and I will see you in the next dividend investing video.